Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, we focus on Nigerian equities performance in Q1 2021 and our expectations. The Nigerian stock market opened the year on a positive note after ranking as the best performing stock market in the world with a whopping annual return of 50% in 2020. The Nigerian Stock Exchange All-Share Index, NSE-ASI, which is used as a measure of how well the stock market is performing, gained 5.3% in January 2021. This is in line with past trends as the Nigerian stock market starts mostly positive in January due to the expectation of corporate actions, dividend and bonuses from quoted companies. Based on the Nigerian Stock Exchange rules, listed companies on the exchange are expected to either publish their unaudited full year results within 1 month before publishing the audited within 3 months, or publish only their audited full year results within 2 months. However, in February, this upward trend in the market reversed as the stock market started a negative trend, falling by 6.2% month on month and 1.2% year to date. This unimpressive performance continued in March and the market lost 3% in the first quarter despite the impressive corporate actions announced by some of the listed companies. Out of 63 trading days in the quarter, the market recorded gains on 27 trading days, 18 of that in January alone, and lost on 36 trading days. The oil and gas sector was the best performing with a return of 17.5% in the first quarter due to the gain in surplus. However, the industrial goods and banking sectors were the worst performing with a 7.9% and 5.1% negative return respectively in Q1 2021. We attribute the negative performance of the stock market to the improvement in the rates of fixed income instruments, treasury bills, fixed deposits, FGM bonds and commercial paper and so on, which started in February. This reduced the interest of the PFAs and domestic institutional investors in the stock market as the dividend yield, which is the return based on expected dividend relative to current share price, became less attractive when compared to the return from investment in fixed income instruments. We expect the stock market to remain down in the second quarter of 2021 based on our expectation of continued increase in fixed income rates. As a result, investors are expected to remain cautious and target companies that can deliver dividend yield of over 10 to 14% within the next 12 months, assuming the company retains the last dividend paid. This implies that we expect the stock prices of these companies to drop to an attractive entry level within the second quarter. That said, with the announcement of interim dividend in the third quarter, we may begin to see some improvements, but this will still be dependent on the level of fixed income rates. We expect the top banks in the banking sector, the industrial sector, the telecommunication sector, large cap stocks in the consumer goods sector and the agriculture sector to have a positive outing in 2021. As you are aware, stock market investing should be for the long term and investors with high risk appetite. If you are able to invest in stocks that deliver a dividend return of 10 to 14% on an annual basis, then you don't have to worry as this return will be competitive against fixed income rates in the medium to long term. In this case, your investment in stocks can be a source of diversification for your portfolio, that is, the proportion of your total investment allocated to stocks. If you missed the episode on understanding investment in stocks, kindly request or visit the YouTube channel to listen. Thank you for listening. Please join us same time next week for another exciting and interesting session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070-8246-3747. Stay blessed.